I've touched base on this, the two extremes, war on the one side and on the other side, an effective deterrence going forward. Where do we come down on this at the moment?
I think the market are coming down more towards effective deterrence. They're seeing this in the context of what has been a series of Iranian aggression, and they see this as the U.S. drawing a line. And all that is reinforcing what has been very strong conditioning over the last few years, which is to fade these shocks. And that's why you see such a muted reaction in markets.
When you are conditioned by events like this, like September, for example, I just wonder to what extent it means we end up underestimating real risk, even when it's right in front of our face. And Mohammed, I use September as an example. The attacks on Aramco oil infrastructure. Crude ended up back to where it was before the attacks within just a couple of weeks. Is that the right parallel here, or is it a mistake to use that and be conditioned by it to think that this goes away quickly?
That's brilliantly put, John, because that speaks directly to the bigger issue. And the bigger issue is that you have positive short-term market momentum versus increasing medium-term uncertainties. That's what it's been all about, and investors have had to navigate this. Be constructive in the short term, but be aware that over the medium term, you have a whole host of uncertainties. They're not just geopolitical. They are economic, they're financial, they're institutional, and they're social. So that is the tug of war playing out. But in the short term, markets have been very confident betting on constructive momentum. And that's what's going to happen again today.
And Mohammed, that's been the right call. And it was the right call certainly through the last 12 months with risk assets really performing and performing well. Your view for 2020, help us navigate the year ahead. Does that change? And how would you allocate capital differently?
So my view has been that you've got a position to do two things. One is keep a claim on the upside, and two, increasingly protect against the downside. How do you do that? Up in quality trades, stress, balance sheet, and cash flow. Two, do not fade the U.S. The U.S. will do better in relative terms, notwithstanding its massive outperformance. And three, try to be much more selective. Be careful of just buying the index. If you do that, then you can retain the claim on the upside while protecting more against the downside.
Mohammed, I want to pick up on two. The consensus call that was established over the last several months going into a new year, overweight the rest of the world versus the United States. You're pushing against the crowd a little bit, Mohammed. Why?
I've been pushing against the crowd for the last 2 years on this. People have been saying over and over again, fade the U.S., fade the U.S. And my reaction has been, not yet. The U.S. has resilience and agility that the rest of the world does not have. And if we're entering a more uncertain time, the resilience is really important. The time will come to fade the U.S. because the outperformance has been so massive. But it is not now, John.